Been an interesting couple of weeks, hasn't it? I'm a Stocklips here for Sunday Night Finance. I'm going to talk about some of the stuff that's going on this week, what I'm doing, what my opinions are. I've got a lot to talk about. But first off, let's take a look at what's going on with the futures, just to get an idea of what might happen with the stock and crypto market in the upcoming week. We've got a little bit of a jump, but not too much. When you're dealing with dollar sizes of this amount, it's not that big of a jump to see it go that high. We'll see how this goes over time, see if there's a trend, see if things stay where they are. Kind of want to get an idea of what's going on. We've got a lot coming up. This is a very important week. So we've been kind of laying low for the past couple of weeks just because we've been waiting for data. We had a Fed meeting. There's been a lot that's gone on. There's been CPI, there's been CPE. Right now, what we're thinking about is huge earnings, then Fed meeting. This is so volatile right now. We're waiting to see where the Fed is going to stop with their interest rates. That's basically what the market's waiting for. Everybody's sitting around trying to figure out what the best stock is, what this is, where the market's going to go. It's not that difficult. All you have to see is where's the money coming from? The people that you borrow it from. And the Fed is affecting their ability to lend it to them and lend it to you, lend it to all of us. When the Fed steps in, they're affecting demand. There's supply and there's demand. The supply side has to be dealt with directly. That's the actual physical items, the actual labor, everything that goes into making the product and getting it to where it needs to be. That's the supply side. The Fed can only mess with the demand side because what they're doing is messing with money. Then basically what I mean by that is the psychological view that people have of the market and the ability to borrow money. Those are the two things. Like borrowing is how money comes into creation in the economy. Like this is how it's set up. People think it's all coming from the Fed. No, it comes from lending. I mean, the Fed prints physical dollars to replace ones that are worn or destroyed or whatever. But all in all, the money that's new to the system that's coming in is mostly from lending in different areas. Not all just regular buying a house lending, but lending all over the market. Just anytime you're borrowing money under this system, you're paying some kind of interest and you're keeping the, quote, Ponzi scheme going. Like, it is a Ponzi scheme, but as long as people do it, it's going to work fine. And the reason I say this is I have this little meme right here. Well, actually, I screen capped this a few months ago. This is what you're always seeing, right? Be careful. This will be the biggest crash in world history. Don't buy anything now. You got an important dude. He used to work on Facebook. He's so important. He likes to buy things in the market that don't go up and then he loses money, but we could still pay attention to him for some reason. But that's what's going on here. We've got so much fear coming in. The market's still going to go down. It's going to be there for a while. That's okay. That's what we've been waiting for because right now we have a market that is out of control. So if I go over here to charts and actually show the ES on a longer timeline, so we've got this on the weekly timeline, this is what we're dealing with in the big picture. This is the pandemic drop. This was the drop of 2018. This was the bull market squeeze after the elections were over. And then you've got the China trade war, which caused tensions here. I mean, most goods that we're selling here probably come from China. So that was an important day. And you can see, or that was an important time. And you can see everything in the charts. So we've come up quite a bit. And this is only going back to 2010. You know, if you keep going, you can see the 2008 crisis. You can see the dot-com crash. You can see the dot-com boom, which is very important. I mean, look at this. This looks a lot like what we have today because we had new technology coming in and we had ways for traders to trade that would have never been in the market. I mean, it used to be very difficult to buy a stock. Quite a while ago, you'd have to call somebody, and they'd have to send somebody to the trading floor to actually make the purchase for you. And that person's competing with a bunch of other people, and they're yelling and screaming, and who knows what happens, who knows what price you get, right? And then that person has to bring it back and say, all right, I got the thing, here you go. So it's this complicated system, and commission was expensive because it was really labor-intensive to make a good stock pick. Like, you couldn't just come into the market and buy something. You had to have people that knew what they were doing, could get in at the right times, get the stuff they needed. So there was a fee. It was a pretty substantial fee to buy or sell or do anything because it was a headache to do it for those companies. But you know what? That's what they did, and that's how they made money. Then at some point, we got to the electronic age where everything can just be done electronically. You don't have to worry about these people running into the floor and competing with each other for prices. And I mean, because if you think about that, like there's the electronic competition, but then there's the physical competition. You know, there's people that don't know as much about stocks, but just can get in there and get their orders because they're big physical presence or something like that. You know, like the market was a totally different place at that point. Although it's not really all that different today because we have different problems. I mean, now it's all electronic. It's who can get the thing fast enough. Right? You've got people competing to get shorter and shorter spaces to the central hub of where everything is traded so they can have priority on the internet chain. You know, like they're paying huge amounts of money to be like just a few clicks ahead of somebody electronically, but that few clicks can make so much of a difference in that world. We're in this world where that's what these huge institutions are doing. They're battling each other with algos and all these strategies and who can get there first and who can dominate this. I was reading a story this week about weaponized gamma, which is hilarious because that's basically exactly what Wall Street Bet's GameStop people were doing. They were basically taking advantage of the people that sold options. So in the market, there are option sellers that are taking on the risk for whatever the investment is, and then there are option buyers that are coming in to try to make a huge gain on the difference if they can. Although usually they are the ones that fail and the option sellers are the ones that win. But right at the end of option contracts, their price is pretty much gone to almost nothing. So if you're still holding those, you've lost basically everything at this point, and nobody's going to buy it because they know the stock's not going to go past the price that you wanted to get it to. And I lost my train of thought, so that's fine. This is an important show. If you want chances to make money, these are the chances. I've been laying low for the past couple of weeks, months, whatever it is, but it's time to get up again because we've got earnings, we've got a Fed meeting, we've got an election, and after that, we've got a possible tax law selling year. And there could be a Santa Claus rally. That's the other thing. People aren't thinking about a Santa Claus rally as much as they should be because those things come up, bite you. And apparently, according to the data from one random article I read, after election season, Santa Claus rallies are extremely likely, which I wouldn't be surprised because right now the deals are great. I was just talking to somebody about how much I love the fact that prices have come down as low as they have. Right? Like to a lot of people, this is horrible because they've lost a ton of money. But to me, since I missed out on a bunch of this is a great opportunity to buy into stuff. And that's what I've been doing. I mean, I've been from probably about somewhere in here when things were getting really bad. I remember seeing the market like this and kind of thinking about buying, maybe nibbling here and there when things were going down here. But once this like big red streak happened, in fact, let me zoom in on it a little bit so you can get an idea what I'm talking about here. So you can see there was like some consolidation down here, a big drop, a big bounce back up, and then it sort of stayed in this range. And that makes sense because after a huge move, there has to be a consolidation period where all the people that were getting out are out, and the people that wanted to reposition themselves at a better price have either done that or have mostly done that. And that's what you get around here because then people start getting desperate to buy, and that's why it bounces so much. They're like, all right, this has come down too low. It's finally time to buy. And I'm talking about the big players, like not the retail investors or small entities, whatever, like the really big players with a lot of money that only look at huge timelines and come to grab when things get down to the levels they want. Like a lot of us are looking at, either intraday or we're looking at daily, weekly, something like that. I mean, these people are looking at yearly, monthly, weekly, whatever it is. They're trying to get long time frames, and you'll see support and resistance on those long time frames. It tends to hold better than the ones that you're looking at daily. So that's why I don't like day trading, because you're using all of your resources to try to like figure out these small moves when the big ones are probably where it's going to be. And if you bet on those rather than the daily ones, you're probably going to have a much higher success rate, because look at how much smoother things are in the weekly timeline than if I were to switch it to the daily timeline. But you can see like there's a huge amount of congestion on any direction. So it looks like things are turning around all the time. There'll be like a few weeks of it going down and then suddenly like 2 huge green boosts. And that's because the buying levels got to a point where people wanted to get them. And like, look at every time it comes down to here, this is about where it rests, because it goes down and boom, pops back up really hard, right? Slowly trends down, gets slammed up multiple times. So this level is starting to turn into kind of resistance for this if we don't continue to go down. Because here's the thing, I think we're going to actually continue to go down a little bit more because we still have the Fed coming up. We've got earnings. We've got the end of the year. There's at least, 2.5 months until the end of the year. So I wouldn't say that this is going to be the final level or this is going to be the inflection point or any of that stuff. I think it's going to continue to go down, actually. I think we're having a bounce. I don't know how high this is going to go, but we've had this trend of like bounces and then lower lows, right? And the bounces come to lower highs, and we get another trend down to lower lows. So we're still on this downward trend in the long term. I mean, people are looking at the daily, like right now, if you look at this, we've been at the same level for quite a while. This entire contract cycle, we basically opened up here, dropped, and then we've sat at this level. But the volatility that's throwing us around this level is really high. And that's what's interesting, is that volatility is telling you that huge players are changing positions right now. That's what makes these things move so much. I mean, these little nibbles that the retail investors like us are doing kind of move things, and depending upon the volume can move them quite a bit. But if it's a high volume day and things are trading as is, retail traders aren't going to move the needle all that much, if at all. So the big players that come in and move them, and they're trying not to, like they're trying to buy these in ways that doesn't mess with the market, right? There's also like huge exchanges and dark pools that supposedly don't affect the market, but you never really know with all that kind of stuff. But there are huge players changing hands right here, and that's what's important. So the fact that I can see that tells me it's a strong level of either support or resistance. Now, if I'm saying there's going to be support or I'm saying there's resistance, I'm not saying that that's where the change is going to happen in the trend. I'm saying that's where congestion is going to get heavy. So even if it goes through that, it's going to consolidate for a while. And that's what that looks like this is. Because if I back up, this level right here has that same high volume movement, high volatility movement, with actually confirmed volume on those levels. So right here tends to be a level where people change hands quite a bit. And that is above the old high of the pre-pandemic drop, because that's kind of an important point right here. You think about everything that happened through the entire 2010s all the way up to 2020. There's finally this huge drop, right? After 2018, where the kind of mini scare happened, where, that was crazy. There were a few red days in a row where like we were really moving down, and people don't give this credit. Like this little drop or this big drop right here was actually like, it seemed worse than all these other ones up here. I think first because it was probably one of the first ones I'd ever experienced that was that bad. If you go back and look, everything is just up, up, up. So that's really the first bad thing since the election. Yeah, since the election, because right now we're in an election season. So we're at a point where people want to be safe with their investments. They want to have just enough to make sure that they can survive it if it drops, but they don't miss out on any bumps. Here we go, Chef Brandon. So yeah, you can miss out on some of the gains, but people who kept holding it have lost out. Sell them by the dips. Yeah, that's what I've been doing. I'm guessing we're going to see a big dip after Apple earnings. I think it's going to be down. See, Apple is a highly weighted stock in a lot of indexes, so I think you can see huge movements on that specific company. But the other thing is there are so many companies reporting next week on the same time that it can amplify everything. Because like if Apple guides a certain way and it matches up with a few other companies, that can move the market huge. In fact, I think when the Fed meets, they're going to take what these companies say into account, because that's what they're thinking. They're like, all right, what does inflation look like on the data, and then what are people doing about it? Because they have those two things to deal with. They have to deal with the actual number, and they have to deal with the psyche of the people that are running the system, because that's what the system is. Like, yes, it's fake. It's supposed to be. It's supposed to protect us from everything, and if you run it right, it doesn't have to hurt people, and that's what it's trying to get to. But there are so many factors and so many barriers that are preventing it from doing that. And right now we're in this downtrend, which is an opportunity to buy when things continue to go up. Does that mean it's not going to continue to go down? No, it's definitely going to continue to go down. Well, I'm not going to say definitely, but as close to definitely as you can get, because we have so much uncertainty coming. Unless next week, like you're saying, Chef Brandon, Apple is slowing production on their new iPhone, big indicator of the rest of the tech. What platform is this? Interactive Brokers? No, I'm using Thinkorswim on TD Ameritrade, actually. It just, for me, this is the best program to look at charts and figure everything out. But for news, it's not as great. Like, you'll get the up-to-date news as it's happening, the important stuff, yes, but if you have to go digging, it's probably better to go with an internet search or something else. But I do like the way this looks. That's why I've set up all these different screens. Like right now, I've got this set up for the main trading screen, which I don't do anything on the weekend, so it's not that big of a deal. I just want to see what the movements are. Like, I've got level 2 right here, and I've also got it right here in Active Trader, which is like their little trading program. And I like that because it helps you visualize the market in a different way. If you think about it, like, price is moving in a column like this. Robinhood kind of figured that out and set up their system to where, number one, it fits with phones, which is, I think, the reason they did that. But it just happens to sync up with the fact that this is what price is doing. If you picture stock prices like in an actual physical form, they move up and down and left and right on things. So it's good to see that take shape right here, because level 2 is cool when you can see the numbers. You can see how many people are bidding and what they're bidding, how many people are selling and what they're selling it for, and what exchanges they're coming from, and that's all good. But it doesn't help you really visualize what that looks like. This helps you visualize it as if it was a structure, which is what I really like about it. So I use that to just kind of see what the market's doing, and the futures open on Sundays is a great opportunity to see what might happen with the stock market. It tells you how bullish or bearish people are that actively trade futures and are in that deep into trading. Because most of us are just kind of passive investors, or we're traders or whatever, but some people are into it. They're trying to trade all the time. They're on crypto. They're on futures. There are people that know so much more about world geopolitics that they play futures just to make a living on a huge scale. So, I'm trying to watch what these people are thinking about the market and what it looks like preemptively. Because on Monday, who knows what's going to happen? Like the futures never really, they rarely ever predict the actual move, but it's good to see what is happening with people that are, because if they're really concerned, you'll see a huge move in the futures. That's why I look at them. Even though I don't trade them, it's like if the futures make a massive move all of a sudden, then that tells me, okay, something important really happened because the big money is shifting and all the orders were market orders, which means before the market, they just say, buy me at any price when the market opens. And that can be catastrophic, which is why you get these big pumps. In fact, that's exactly what happened. People wanted to get things, they have their limit orders. So some people are smart and they say, all right, I only want to get it if it's going to be within this range. And other people are just like, no, just give it to me at whatever price. So they do the market order and they all stack up right there. And the second the market opens, the algos take advantage of that and they sell them a bunch of contracts. It goes whoop, sell a bunch of shares. Everything just pops right up because they got market orders just stacked up. It's like opening the floodgates and having it all spill in. But if you look at what happened, we got that big rush of orders and then everything kind of settled in this range right here for now. I mean, this is a short-term range, but it's respecting VWAP, which is volume weighted average price. It's a way to kind of tell what the if the market is bullish or bearish and what a fair deal for the day on the prices would be. Like if you're somewhere around VWAP, then that, based on the trading, that's where the price should be theoretically. That doesn't mean it actually is going to be that price because everything has to do with who's buying, who's selling, what they're buying it for, what they're selling it for, etc. So you're just kind of getting a basic idea, and that's why I do it. But this is Thinkorswim. It's an interesting platform. It allows you to customize things quite a bit. I have so many different screens. This is just the one I use for Sunday Night Finance here. I've got my lists over here. I've got the currency. I've got an active view of the S&P 500 futures, which I use through the E-minis/ES on there, so I can just kind of get a basic idea of what's going on. You don't have to be too in-depth and go crazy with it. Just getting a basic idea is all you need. Like, what are the currencies doing? What are stocks doing? What are bonds doing? Although this isn't going to tell me anything because I'm still kind of setting some of this stuff up. But bonds are important, and actually I want to talk about that a little bit later. But yeah, that's what I'm doing. So are you a full-time trader? No, I am a side hustle trader. I don't have the cash to be a full-time trader, and I don't have the stomach to be a full-time trader. So my relationship with it, which that was actually what I was trying to do. I wanted to do that, but it didn't work out. So I put it more as a side hustle. And since I've done that, things have improved quite a bit. Hold on, I got to take a quick sip of water. The whole point of this broadcast today is we have so much coming up. We have the Fed meeting and we have earnings. There's more than that, but the two things that we're worrying about right now are the Fed meeting and earnings, because next week is the first huge week of earnings. We already had the banks. Traditionally, when this season happens, you have early reporters that don't move the market too much. Then you have the banks, which kind of give you like your starting point. You know, if the banks are feeling okay, then you've got hope for everything else. If the banks aren't feeling okay, then you're kind of questionable when you go into everyone else's earnings. So we've had the banks, and now we're moving on to the actual huge stocks. Like you're talking about Apple, right? Apple's going to report next week. I think Facebook is. Let me see. I've got actually a list right here, and that's what I wanted to go over. And then after we get those earnings, we're going to have the Fed meeting next week, which is the next chance to actually make an active trade for me, because I don't usually make day trades. But when the Fed reports, if things go the way I think they're supposed to go, then I like to make a decent trade with a good portion of my cash, but not enough to hurt me too much if it doesn't work out. I'm mostly like a swing trader. I like to practice it over time because it seems to me that it's easier to predict long-term movements than the short-term ones. So I like to get things at a good price, get beat up for a few days, maybe a few weeks, and then actually take a little bit of profit. And if it goes higher, whatever, but just get what I know I can get from the long-term trends. So that's what I'm looking for going into this this week of earnings. We've got so many things. Let me up this list right here. Next week has quite a bit, and this isn't everything. This is just what I'm looking at for next week. But there are a lot of big companies in here. So we've got possibly Twitter, but yeah, 27. So possibly Twitter. We don't know if they're actually going to go. This whole thing is insane with Elon Musk. It's going to be his first earnings as the new dude that owns it, and they're even still figuring out if he really owns it or not. Like the whole thing is just, I don't even know what's going on with it. So I just kind of ignore Twitter. I'm waiting till this is all done. And I think actually if we have a huge dip in the share price, that might be an opportunity long term for that company, just because they're going to completely change what they're doing, and they're going to change to a model from somebody that's made a bunch of money with other companies. So I think there's at least a possibility that there's a good bounce in that. But right now it's so volatile, I don't even know what to do. Like it's supposed to be sold for that $54.20 a share. I think, but maybe there's going to be some stipulations with that. I really don't know. So I had it right, and I pulled out way too soon on this, and I've been pissed off ever since. So I just leave Twitter alone. I don't like Twitter. It pisses me off. It's like I traded this thing. I knew exactly what was going to happen, and I totally messed it up because I pulled it out when things came back to where they were at the break even, which then dropped my premium prices even more, meaning that I lost a bunch of money on it. And I was like, screw this. I want to get rid of it. And the very next day, the move happened, right? And like 2-3 days later, it was way in that favor. And I thought, man, I got rid of those things the day before it happened. If I just held one more day, man, it would have been good. So I'm pissed off at Twitter. I leave it alone. It's just one of those companies that has so much hype. I don't really like to trade it, and I really shouldn't be trading it anyway because my model is not to play the hype, but to play the fundamentals and the technicals. If the reasonable technicals, I should say, not like some crazy indicator that somebody made up with a million different other indicators combined on a specific day with a specific direction of the wind or whatever. So I just want to get in here, take a look at what's going on, and see what could move the market. So next week we have a bunch of earnings. Apple, yes, we've got Apple. What else do we have? We got Shopify. We've got Waste Management. We've got Teladoc. Let's see. We've got Facebook. Here's a big one. Facebook. I love this stock, actually. Like, this has moved so far down, and it's people are discounting the amount of money that Facebook just has sitting around. They're just like, oh no, the metaverse sucks, so it's all dead, and that's what they're going for. There's not just the metaverse. They're not trying to be like a metaverse only thing. They're trying to actually encompass as much as they possibly can. What I see them doing is acquiring everything that's popular and integrating it into their network and becoming basically the entire world for people. Because you can get their messaging app. There's WhatsApp, there's Instagram, there's Facebook, there's Oculus. All these things are integrated, and there's more stuff that they're working on. They acquired something else that I don't even remember. I think this week maybe, or a couple of weeks ago, whatever it was. They're just like a powerhouse that people get too caught up in because they're like, oh, Facebook, it's only for like Gen Xers and millennials and boomers and stuff. Like, yeah, that's kind of the demographic of it now, but it's still being used by everybody. It's unbelievable how often I run into people that still use Facebook. So it's like, great. Hey, I still use Facebook too. Not as much, but at least it's there. It's the original, and it's got Instagram. It's got Oculus. Like I said, it's got WhatsApp. It's got all these really popular apps and devices and everything else. It's in so many different worlds. So I like the fact that it's just dropped. I've been buying it, right? I think I started buying it when it was in here before earnings. Maybe it kind of like bottomed. I bought a little bit of it, and then when it had this huge decline down into here sometime maybe a week ago, I bought a little bit more. So I'm liking this one. For me, this is just a no-brainer in the fundamentals. Like, go look at their balance sheet, right? Like, look at everybody else's balance sheet that's doing anything in the tech world, right? It's decent because tech kind of made out well in the last few decades, but like, if you're a good company, that is, if you're one of the big take advantage of everything companies, then yeah, you did well. And that's what Facebook did. So I'm looking at, they're being grouped in with everything else. They're using their own bias against Facebook, because they just look at Facebook as Facebook. They don't look at Facebook as Meta. And the whole thing, the reason they changed to Meta is to say like, hey, we're doing a bunch of different stuff at the same time. Yes, it's ridiculous. I know people were making fun of it left and right, and so was I, because it's funny and it's dumb, but it's leading them in the right direction, right? Like my name, right? The whole Astocalypse thing. You have any idea how difficult it is for people to pronounce that? Every time I go into a new channel, they're like, Stockpocalypse, Stockaplock. Like, they can't say it. Nobody can say it right. Some people can. And I'm like, all right, good. You got it. You actually read it. It's like, it's apocalypse, but you change it to stock, right? It's stupid as hell. But you know what happened? It got me to move past that point and actually do the thing. Yeah, it's funny that it's a stupid name, and I kept it and think like, I regretted it for a while, but I'm like, no, actually it's dumb. The fact that these people stumble on my name is going to make them feel awkward, which is going to like seal into their brain chemically me. Like, they're going to remember me. It's going to be awkward, but at least they're going to do it. So that's like the thing. It's like, okay, it's awkward and it's dumb, but people remember it at least. And that's the whole point. People are making fun of everything, but they're remembering it. Like, are you doing all that popular shit that you're making fun of? No, you're not. Are you getting popular for it and getting all of the benefits that come with that? No. So you're jealous. So you're making fun of it. And that's what I'm trying not to do. I'm trying to actually find the thing that becomes it so that people can make fun of me. Anyway, so yeah, I like Meta. Let's go with that. I like Meta. It's a good one. I've been buying a little bit of it. If it goes down even more, which like the fact that on the year, if you look down here on this chart, it's down really far from its highs. It's a good candidate for a sell-off for a tax loss thing at the end of the year. People that are holding positions that are way underwater start thinking about in December, all right, do I want to dump this and take the loss so I can offset some of the gains on my win? Or do I want to hold this and hope that it comes back? That decision gets people going. And in December, when things really drop, usually I should say mid-December, early December, somewhere around there, when things really, really drop, when there's a huge fear of everything, that's when the people that really want it start to come in and it forms like a little base. We get a jump at the end of the year if there's a Santa Claus rally. And that's the thing, like anything I say is a possibility. I'm not saying any of this is going to happen. I'm saying this could happen. So if you're able to see that, you might be able to take advantage of it. And that's what I'm trying to do with this. If I get some good down stocks that get sold off really hard at the end of the year before Christmas, because there's that Santa Claus rally that'll bite you, and I've seen that. That's what happened in 2018. Like there was a huge Santa Claus rally in 2018. People jumped in right away and they picked it up, and nobody believed that it was coming back. That's what happens every single time we get one of these things. Nobody believes that it's coming back. They're like, "Oh, it's done. Look at this huge drop. I'm going to short harder." No, that's why it's coming back, because you're shorting harder. You're providing the fuel. The more you deny the fact that the economic world has a way to continue to go on because it has assets. It has assets more than it has paper. So even if the paper goes, the assets are going to be are still going to be there. The assets are the important part. When everything goes to crap, having actual stuff is what's important. So the Western world and the Eastern world have stuff. If things crash in the paper world, they still have the things. They still have tanks. They still have energy. Right? They still have gold. They still have food and water and all this other stuff, actual physical stuff. It's all the people in the markets that if everything crashes will be in trouble. And because there are so many people in both domains, it's not going to crash fully. It's always going to get to a level where people with money say, oh man, this is too much of a bargain. Because that's all they're watching is the huge timelines, which don't move that much. Those take a longer time to actually see progress in. So most of the time, those people with money aren't buying anything, or they're making stupid little trades to pass the time. You know, once they get an actual generational buying opportunity, that's when these bounces happen. And something fundamentally different has to happen with the system in order for that to take effect. So that could happen. And some of the stuff we see with earnings might affect that, because that will affect what the Fed says. And the Fed is telling the market how high or low it has to go. So that's what we're looking at. All right, I've got something down here that I missed out on. So Facebook is an ad machine. Yes, ad machine. Exactly. That's the other thing I like about Facebook. The fact that they're selling ads and they're figuring out how to sell ads in better ways. Like that's where all the money is. They've got attention is the thing, right? Attention is the currency, and they've got attention, so they're using it to monetize. And people want to advertise with them because it actually gets them money. I can't tell you how many times I've heard from people like, "Oh, I bought this blanket because I saw it on Facebook or whatever." Like, why are you buying stuff on Facebook? To me, Facebook is still this thing that you talk to people on, and it's like anything that advertises is like, whatever. But that's just what it is now. Everything's advertised in the same space. Everything is like, it's all TikTok. It's all videos, because we have the ability to do it. Everybody's got a phone powerful enough with a camera nice enough to just shoot these videos. That's what we're in now. We're in this different world. So yeah, Facebook, it's an ad machine. I love it. I absolutely love it. Do I know about options? Yes, I do know about options. No, I'm not a full-time trader. I trade options because of my account size. If you want to trade shares, you usually need more money because it's more expensive to trade shares. So I trade options to make sure that I can get similar gains with less money and hopefully less risk. That's the important thing. Make sure it's less risk. All right, so what else do we have here? If a call option is exercised, the shares are delivered, correct? If a put option is exercised, then it does not automatically, or then does it automatically get sold, and the difference, if any, credited to your account? Yeah, so if a call option is exercised and you're the buyer of the call option, then yes, you get to buy those 100 shares or however many increments of 100 you bought, because each contract is 100 shares. So you're entitled to that. If you sold that, you have to provide the shares. So hopefully you own the shares first, so you're selling at a profit. But if not, if you sold it without the shares, then you're shorting it, and you have to go buy the shares at a horribly high price in order to give it to the people that are exercising the option. So to me, I like the wheel strategy, where you're actually owning the shares and you're selling calls against, an asset. Like, shares are an asset. And when I was talking about physical assets, you can also have digital assets, monetary assets. And that's what I like about stocks. They are assets. They have inflationary value. As inflation goes up, it lifts the market, because the money that's being pumped into the system always ends up in these different areas. And the stock market, the bond market, they're basically like little pockets in the side of the river that catch water. And that's what they're doing. They're catching this this money that instead of water, and they're putting it to work in these little structures within. And that's what you're seeing with stocks like Meta and what you're seeing with the options on them. So people are actually having to buy these stocks, sell them back because they didn't own them, and now they're down quite a bit. But if you say, hey, I like this company, I'm going to buy it cheap, and you make sure you buy it in increments of 100, or you work up to have 100, depending upon what you're working with and how expensive the stock is, then you can actually have a profit when you sell those calls. And the other thing that's nice is if the price drops and you actually do believe in the company, having the shares is good because there's no time limit on it. If you have options and everything drops, you get murdered because the premium drops. The premium is levered. So what you're seeing with options, for every dollar the stock moves, an option moves $100 if it's deep enough in the money. That's basically the draw of options. You can get more per dollar if you're trading them with the premium. And sometimes you can actually use them as insurance. Like if you think the stock's going to drop quite a bit, you can buy some put options so that way if it does, you can still sell your stock at that higher price to protect yourself. Options are basically insurance. If you're in the insurance game, you could be in the options game. It's essentially the exact same thing. Hey, first time chat, Simmercourt. Hey, how's it going? Good to have you here. We're just talking about the market, what my predictions are. We've got earnings coming up. We've got a Fed meeting, so there's a lot to talk about. I actually got sidetracked, so I should jump back into that. Thank you for coming on. All right, so we've got earnings next week, and we're going to have a Fed meeting after that. I've said that a million times, but that's what you need to remember because that's what's going to move the markets, right? The Fed basically ensures that a certain amount of money will be available for people to pump into the market via borrowing. That's where the money that pumped everything up came from. This run up, because this is Meta, so while it was running up in this area right here, 2020 and 2022, it was being pumped up by that exact mechanism, which the rest of the stock market was too. Now we're having a delevering. People that were borrowing money and pumping it up are now having to repay, and they don't have the money to pay it. So prices are dropping because they're selling their assets in order to pay the debt they have from shorting this stuff. Right? When the things flip directions, the people that were ultra long have to cover, and it's going to be difficult for them. So sometimes stuff like this happens. Like this was actually because Meta had some bad guidance, and that's the most important thing when you're looking at where the market is going. What do the companies guide? What do they think is going to happen? So this is all based on what people think is going to happen. The stock market isn't on what's happening right now. The stock market isn't on what's going to happen in the next week or so. It's what people expect the market to be like 6 to 12 months from now. And that's the other important thing I wanted to talk about. So let me switch this back to the actual main chart, and we're going to go to the SPY because I like the fact that the SPY is more broad in the range of people that are able to trade it, so you can kind of get a better idea of what everybody thinks. Because like you'll see from the top of the top to the bottom of the bottom, people will buy shares of SPY. It's one of the oldest ETFs. I don't know if it is. It's the original like S&P one that took off in the early 90s. So it's just an interesting a stock to follow, and it gives me a better idea of what everyone's thinking, right, from the top to the bottom. So let's take a look at this. We've got these movements all the way up here. This is what pumped all the money into the system, all this borrowing, all this speculating. We had the pandemic, and then we had all the stimulus from the pandemic, which allowed the market to bottom. And when that happened, it made other companies confident enough to come out and start lending money and actually start borrowing money as well, because they had to be like, all right, are we confident enough that we can pay back whatever we borrow plus interest and still make a profit? And that's what people are trying to do. They thought right here, like, all right, everything's a lot cheaper. We can do that. So you borrowed money at very little rate. Everything was super cheap because people were scared, and we were able to pump the market extremely. Everybody did, from like the retail investor that finally got interested in it because they were at home and had nothing to do, right? It's like basically a repeat of the 90s, right? The 90s was a time when electronic trading basically entered people's homes because we had the internet. We hadn't had the internet before that, but we did have electronic trading because we had a version of the internet that was a little bit more exclusive, I guess. Like people could get on it. There was a way for everybody to use it, but it was mostly used by the people that invented it and people with money that were involved in that system. So it's kind of a different idea of, what you would consider the internet. At that time, not everybody's able to do it. And then suddenly people were. So there were people that quit their jobs, they jumped on the internet, and they started trading stocks, and they were successful. And there were other people that weren't. But at the time, things were going up. So it was really easy for people to get in and just start throwing money into things. People that didn't know anything. right? And then after a couple of years of that validating what they thought was right, they finally had a crash, didn't know how to deal with it, and got out of the market. Well, eventually it bottoms, and then those people come back in, and they provide the fuel for everyone else that decided to stay with it and jump on the next leg up, because that's what happens. Like, we have the leg up, then we have the pullback, and then it readjusts to the people that really want to be in it. And then eventually, everyone else that was a kind of a fair weather fan gets suckered back in, and they provide the fuel to bump it up once again. And right now, the Fed is basically tightening everything. All the stuff that came out of this last one is causing those people to get out. It's causing institutions that borrowed a bunch of money to either declare bankruptcy or pay it back and put the system back to a more fair amount. And that's what they're trying to do right here. They're trying to convince people psychologically to put their money back into something that makes sense. Get rid of the speculations, get rid of the things they don't really know are going to work out, and pump up everything else that is. And we're kind of getting a consolidation level right here. And that's important to me, because even though I think we can go lower, it's good to see where everybody is. So actually, let me get out of this. So I'm going to restore this cell. And I'm going to go into the one that has the indicators. So I'm not a huge fan of all kinds of technical analysis, but I do like certain things. I've got standard deviation channels, which are these lines coming up right here. And then I've got this volume profile that gives you kind of a level representation of where people were buying in and what the volume is at those levels. So as you can see, the higher you go up, the fewer people are owning those stocks, right? Which makes sense, because people tend to come in, the average person tends to come in later once everything has happened. So a lot of people that were smart were buying in right here, and everybody else didn't believe in it, including me and most traders. Everybody was short. I was short. I actually got lucky enough to hit this right here, and I thought, yes, all right, there we go. I'm going to use that money and go for a quick reverse. No, it kept going. So this thing just destroyed me. And then when it finally flipped around, I was so hurt by this drop that I thought, no, it's not coming back. This is a lie. And it wasn't until it got like up here that I started realizing, okay, maybe it's coming back. So that's what people aren't ready for it. Every time we have these crazy drops, and the first time we've had a slow drop right here is interesting to me, because all these other ones were quick, right? Which tells me, is there going to be a quick response to this in the long term? Because this same kind of a movement on a broader scale would look something like this. If we get a bounce, like if the Fed, we get earnings that are okay and they don't project as bad as people think, and then we get a Fed that says, all right, we're in line for what we've said, we're not going to up our projections anymore, then people are going to be confident enough to be like, all right, the Fed is comfortable again, we can start spending money like we want to. Because people are not spending money. I should say big institutions, the ones that bid up the price of everything, they're not spending as much money because it's more expensive to borrow the cash that they would be doing. And that's what businesses do. They borrow and then they bet on things and they win and they pay it back. And the ones that don't win end up going under, but the ones that do just continue the strategy indefinitely and eventually have enough to withstand losses long enough to continue their way up. Because that's what happens with the market. Like, there are huge losses, but once things come back, once stabilization happens, nobody believes it. So the shorts go up and up and up, because they get blown out down here, and every leg of the way they think, nope, this is it. Nope, this is it. Because there's these little red candles. If I zoom in a little bit, you can see that there's actually a little bit of red. It's not always the same straight up or straight down pattern, right? So eventually there's boom, jumps. They don't think it's going to happen. Don't think it's going to happen. Don't think it's going to happen. And it does. And right now we're kind of at a point where I could see that we're having a bounce again, but we're also having a consolidation level. So if we came in Monday and went straight back down into this level, that would be, to me, not surprising at all. In fact, I think that's the most likely thing. I think we have there's some strength in this bounce, so I can definitely see it moving. But look at this consolidation level. We had these big jumps, and then would be followed by a fall, right? And then another big jump followed by a fall. And it was the same thing throughout the level until it finally broke out. And that was because of positive news, not just because, all the stars lined up or whatever technical analysis want you to think. It's right there by the moving averages, which is another one I have. So I have standard deviation channels, I have the volume profile, and I have moving averages. And the reason I have those because it tells you what algos and traders are thinking. The people that make the algos have to program it to do something. And one of those things is basically just follow these trends. Trade based on these technical analysis indicators, and on your free time, or have other people put out information about using these technical analysis indicators so that they can get more customers to move the market in the way that they want. They get people to think in that manner, they make those moves, and then the algos benefit from it. And they're basically putting out the propaganda that says trade this way, trade this way, trade this way. So I have those up to see what retail traders are thinking. And what I like about them is sometimes they do kind of predict a move. In fact, this congestion right here is just below the standard deviation mark. And I think this is the actual, the middle mark, which is right at a low spot of volume, behind like support here and resistance here. We've got this kind of gap. And that's where we're looking at as far as a level from the 21 moving average, a way to get up if we bounce and continue the trend downward. Because if we have these lower highs, then it could just be that we run into the support, we run into the resistance up in this area and it bounces back off and goes down, which then continues this downward trend. So that's what people are thinking about. Like, is this downward trend going to continue or is this a reversal? I think a reversal is coming soon, but not quite yet. To me, the projections of the Fed has to stay the same for at least a couple of meetings for the market to feel comfortable enough to start thinking about new highs. Because right now the bond market is really appealing. The bond market has a super nice yield. It's going up to the point where the stock market can't keep up, and money is moving from the stock market back into the bond market. Because the bond market is about like $10 trillion bigger than the stock market if you look at like the total volume or whatever. So basically what I'm saying is like the traders are thinking about this trend right here, this lower high, lower high, lower high thing. Is it going to continue? And we've got volume saying that it might. And we've got indicators saying that these areas are nice tops. And if you back up and look at the standard deviation channels, you've got a median way down here. So this is the 1.5 standard deviation channel up here. So the median price, according to trading over a long period of time, should be more in the 2,800 range or the 289 range if you're using the SPY. So we're still well above the median point. We're at basically the half standard deviation mark, which is actually a decent place to look at support and resistance. Because if you look back here, that was where the stock or the market popped up to before the pandemic. And then when it came up and tested this top again, had some volatility. Right. So when we have spots where there is volatility, that tells me that's an important level. So I don't worry about this stuff. This nice floaty way, of moving up. It's not that big of a deal. But right here, there's kind of some movement, right? There's huge green. There's a gap. There's something that tells me this is where price kind of changed quite a bit. And when you come back here on the way down, you see bumps up to it, right? That means there are a lot of people that actually did buy in right here. This gap meant that a huge amount of people came in. And if you look at the volume, even though it's not much more than the average, it is up. So you can see more than normal. People were buying shares when this gap happened. So this is an important level. People that are in at this gap are underwater right now. And if you look at these big jumps anywhere on the map, right? You take the pandemic out for a second because that's a crazy event. There are ones here, there are ones here, there's one here, there's one here. These got to tell you these are areas where huge movement happened because a lot of shares changed hands quickly. And it was most likely because there was some news event that caused it. One of those things is the election. So that's the third thing. Yeah. The Fed, earnings, and election right now. That is so much stress to put on a stock market, so much stress to put on a market in general, that people aren't taking into account how much that's affecting what's going on. And before events like this happen, downward trends tend to be the norm because people are getting out of their positions anticipating that it could be really, really bad, because it could be. You never know. It's always good to make yourself safe. And that's what people are doing, but they're kind of taking it to extreme, which is moving the market downward slowly. Even though we get these jumps, that's why we're getting these lower highs, because people are getting more and more afraid. Every time the people that bought in up here start to get hope that it's coming back to their break-even point, it pops down lower. And that's crushing them, which is causing them to get out of the market even more. And the more people get out, the more likely it is that we've actually hit a bottom. That's what we're looking for. Are we hitting a bottom? And I think we're getting close. This half standard deviation mark tends to be pretty strong. Looking at the past, that's where it bounced off of. Anytime it went above this, it had some huge movement. It got rejected and bounced right off of it again and again. And yes, it's not perfect. It goes below it a little bit. But if you can think about it like a magnet or something, like it's drawing it towards it, it's not necessarily the exact spot. It's just the fact that things in that area are moving quickly, and there's a lot of volume to confirm that that was an important event, causing people to think in the manner that would cause that move. So that's what I'm looking for. What are those events that are moving things like that? And right now we're getting what looks like a little consolidation mark. People are still thinking it's going to drop. I agree, actually, because the volume is thin. So what do you do in that circumstance? Well, one, you have some cash. You get ready for some more drops. You get ready to buy things that you want. And be prepared to have it continue to go, right? You're never going to hit the bottom, or maybe you will hit the bottom, but if you do, it's going to be briefly. And what you're going to think is during this whole drop, you could have been buying. You don't care what price it is. You're like, oh, well, if it's here or it's here, that's a big deal. I don't want to, it was just here a few days ago and I'm up here now. I don't want to pay that. Well, guess what? You're never going to pay that again, maybe. So it's not a big deal if you buy, you're underwater, it continues to go, if you believe in the investment that you're buying. So I'm not a financial advisor. I don't give financial advice. I just spout my opinion, right? This is just my opinion. And you should do all the research you can, fact check me, double check your sources, do everything you can, because to me, it's all about making sure that you have the best idea based on everything else that's out there. And then, of course, I dropped my paper, so I have to get that real quick. Which is why I'm looking at this. This is an important level. I want to see if this level continues to be consolidation or if it's an inflection point. Here's something else. Is the 200-week moving average. Look at that. It bounced off that. That's a huge level too. So that's why I have these on my screen. I have the 21 through the 200 moving average because those four, right, the 21, the 50, the 100, and the 200 tend to be the most important. Those are the ones you'll see if you pop on financial media and they're talking about stuff, right, because they have to be generalized. So I try to keep things as generalized as possible, see what the masses are thinking, know that I am also part of those masses and only have a slight advantage over that because I understand that. That's the only difference. And I look at this stuff all the time and other people don't. So I have that thing. But the other thing is I'm too deep in the weeds. I look at this stuff all the time. So I have to take my own bias into account, knowing that I can't see the forest through the trees. I'm here looking at like a single mushroom on a tree and someone else is way back looking at the forest saying like, hey, what are you doing down there? And me, I'm thinking I see the whole world in this little fungus. I see everything that's important. Nothing else matters but everything that's in that fungus. So, okay, I'm sorry, Puncher of Kittens, you've asked me or you've made a few statements and I've completely missed it. I get on these rants, right? This is how this thing goes. I come in, try to talk about the futures, try to talk about what I'm doing, but mostly it just ends up with me ranting so much. So what did you say? You said you can get 500 to 1 leverage with options. So you have 20,000, you can buy 10 mil of options. What if you don't think AMD? AMD I like. I'll get to your questions here. I was thinking of shorting that. Right now, maybe. I mean, I think anything could happen. We're into earnings season, so I don't like to make long-term predictions, right? The important thing that happens with earnings is you get the guidance. So if you're trading options and you're looking for a way to play the market, you're looking for something to make money on, you can do it with options. It takes time. You're going to have to learn it. There's going to be a lot of pain involved. So I suggest paper trading, and I suggest doing it slowly, like adding small amounts and building up over time until you're ready to really do it, because it can be really powerful if used properly, but it can also wipe you out. So I never make any trade that would wipe me out. I only use up to a certain amount when I'm trading to make sure that if I blow up completely on that trade, it doesn't kill me. I have multiple investments. I have diversity of investments. I have diversity of strategies. I have diversity of brokers. So I'm making sure that if any of these links fail, I have at least something else. I wanted to think on as many different levels as I can to make sure that I can protect myself in so many different ways. So you're saying, yeah, did they have that 500 to 1 leverage? Yeah, you can find places that give you ridiculous leverage. If you go into the Forex community, you'll see insane leverage on things. People are putting down tiny amounts of money, trading with hundreds of thousands or millions of dollars. It's insane. You can do it, and it's like, oh, we have this firm. Yeah, you have this firm that's all made out of borrowed money, and if people don't succeed, everybody's screwed. Yeah, I understand that. But you got to be careful with what you're doing. You got to double check everything. So in my opinion, it's good to have many opinions and then take the common threads and whatever you like out of that. So, all right, yeah, 500 to 1, there could be crazy leverage, and you can control weird amounts of money. But remember, anytime you agree to that, you're responsible for the entirety of the loan. If you do that 500 to 1 leverage, yeah, that's cool and everything, but you're responsible for that. So make sure you can take on whatever risk you put if you do something like that. That's why I don't use leverage. Yes, that cuts my gains down. That prevents me from making more money quicker, and it keeps me grinding for a longer time. Yes, I understand that, but I'd rather do that than jump up really quick and then fall into a hole that I can never get out of, or I can only get out of with bankruptcy or something like that. So it's just to me, it's better to do cash so that way you're safe. You know what I mean? Like, yeah, it takes longer, whatever. But you're going to be alive, right? People don't think long term. It's like you're going to be alive 5, 10, 20, 30 years in the future. You probably think like, oh, I might die tomorrow. I might die in what? Yeah, you might. You're absolutely right. But it's more likely that you're not, and you're still going to be here. And in that time, if you didn't do anything, what are you going to think? How are you going to feel? You're going to be like, oh man, I'm still in the same place, and I didn't even, I in the past 30 years, in the past 50 years, past 5 years, 1 year, whatever it is, you know? So that's why I like to take up trading as a side hustle and try to get better at it until I get to a point where I can make it my main income source. But at the point I am right now, no. I'm going to have to do this as a side hustle and just learn and do my best. I'm an intermediate trader. That's what I consider myself. I've been trading for 5 years. I'm an intermediate trader. I only know so much. And I know that most of my strategies are only the beginnings of understanding those actual areas of the market. So I'm okay with that. I'm learning. I'm talking to people in chat, which is great. I love it when people come in and they give me ideas. They send me down paths I've never considered. And I start looking up things that I've never looked up before. I learn from it. It's, you know, everybody else learns from it. If you're just sitting there lurking and you're hearing these conversations, you learn from it. That's what I love about this. It's a lot of fun. Like, I trade shares, I trade options, I trade cryptocurrency. I tried to talk about all of it, but I ramble a lot, so I don't end up getting to a lot of the stuff that I want to get to, which sucks, but that's what I do. And then I post them on YouTube, and sometimes I kind of edit it a little bit, so all these like, oh, what do I'm doing, pause, those kind of things get edited out so that you can hear the whole thing in its entirety without all the ums and ahs, unless, you know, it's too overwhelming and I just post it as is, which I'm going to start doing now because it really is overwhelming to edit those videos. It's insane. Like 2.5 to 3 hour videos. It's crazy having to do that every week or every other week. It's still a lot of work. Anyway, so we're talking about this in depth right here. We're in this little possible channel. We're probably going to go lower. We've got earnings next week. Apple could do it. Meta can do it. What else do we have? Let's see. We've got, of the ones I care about, Waste Management. Or Shopify. There's one. Look at, they're down. I like that chart. They're still the same company. Waste Management, they're a wonderful company. They're not down that much, but if you think of like actual assets and actual necessity, Waste Management, like getting rid of garbage, is very important. You're not, no matter what happens with everything, whether if we just turn into technological computers tomorrow, right? Our brains are in a computer and everything is like, we don't need, there's still gonna be garbage, right? Because we have physical stuff that needs to happen. Like, garbage is gonna have to be moved. So to me, like, Waste Management, even in apocalypse, is gonna be necessary. You've got garbage, you got to get rid of it. So to me, that's a nice stock. That's reporting. They're a big stock. They have a lot of shares. There's a huge volume in there. In fact, so I like to have the amount of shares listed because that tells me how big the thing is. If it's the smaller the float is, which is the amount that we have access to, basically the amount of shares available to the public, the smaller that is, the easier it is for a tiny amount of buys to equal a big amount of moves. And if you have something that only has a few shares and people buy most of them and everybody else wants to, well, then a price war comes up that raises the price quite a bit. So that's what happened with GameStop and all these other ones. They weren't big floats. People were shorting them. And the fact that there were no shares available when they went to cover meant that the price went up like crazy. So certain things will do that, you know, like certain things are necessary. So that's why I say I like Waste Management. They're reporting. We've got Meta reporting. We've got Apple reporting. We've got Chipotle reporting. Look at this. This is a wonderful stock. People make fun of Chipotle so much, but they don't think about the fact that, like, it's extremely successful. Look at the market, right? How low we were just looking at the market forever. It was down here, right? Chipotle's way up here, and it stays up there. I mean, it's probably going to continue to drop, but it's $1,500. It's an insanely expensive stock. I remember this thing when it was like a couple hundred or something, and I was like, oh, it just keeps going up. Interesting. I wish I had bought some then when it was like $300, $400, $500, but I didn't, because you never really know with stuff like this. And suddenly, even having one share is extremely profitable. Same with Tesla. I remember looking at Tesla in the 250s going like, I'll see if it drops to the low 200s. You think about that with Tesla, like pre-split, before it had any split, I was thinking like 250 is not good enough. I mean, you really never know with the market. So saying what you're going to do in any kind of situation is difficult. And that's why I like to look at the market in the way I do, because people think that they know the market. They think that they know what they would do in a huge drop. Well, guess what? We've got a drop. And you know what those people are doing right now? They're quitting the market. They're panicking. I jumped into some stock market channel the other day that was playing a video game, and I was like, hey, you talking about the stock market? He goes, oh, I haven't been investing in that in like months now. I was just like, what are you talking? Why are you stock market then? You know, like, people get in, they think they're going to make all this money and they don't. So they leave, and they're not paying attention to the long-term trend. They're paying attention to the fact that, like, oh, it's down. Well, guess what? Now is buying time. right? This is what you wait for. When you see the thing going up for years and years and years, you go, man, I wish I'd bought more during that time. I wish I was buying it didn't matter when, it's still lower than today. So when you get these opportunities in the market, you got to take them. And look what happened to Chipotle. People keep gobbling it up because it's a good stock on the stock market. I don't care what you think about the company in the actual form, what your opinions are or whatever. It's the actual performance of the company in the economic world and in the stock market. That's the important thing when you're trying to make money in these vectors. It does well in those vectors. So I like it. It's a big company. It's got a small float. This is another reason why it's so high. Look at this. 27 million shares? Is that all? I actually never really looked at that. Holy crap. Look at that. 27 million is nothing. That's like basically next to zero shares as far as this is why the stock is $1,500 because there are only 27 million shares. Look at these other ones, right? Coca-Cola has 4 billion shares. 4 billion. Look at it, it's up, right? Coca-Cola is a juggernaut. It's a blue chip stock. It's been good forever. It's a safe bet. You're not going to make $1 million on it but look at how predictable it is. This is one of the only stocks I see that rides the median in the standard deviation channel, right? So this line right here that continues through all this is the median. It's the mean price based on all the trading that's happened. And look at how well it respects that line. Up, down, up, down, up, down. It's on either side of it consistently. It's very smooth. You don't see stocks that move just like this very easily. Yeah, there's that big drop, but look at what happened. It corrected and came right back. And it dropped, and it's probably going to continue to correct. Why? Because we're pumping money into the system. All the stuff you think about that's like, oh, it's so bad. I hate the fact that we're doing this. Yeah, I know. I hate it too. But guess what it's going to do? It's going to all flood into the market. It is literally like water. Water gets into everything. You have something you put into the river and you break it, the water will get into it. And that's what's happening with all this stuff. We're adding a bunch of cash. It's cracking the system. The water is flowing in and the entire sea rises. Yes, certain entities get destroyed and you have to avoid those entities. That's the trick. That's what we're looking for. But the overall market gets propped up. The rising tide lifts all boats. And inflation, after everything settles, will help people with assets. That's why the U.S. government wants it. They want a 2% inflation, right? The Fed's always looking at 2% inflation, 2% inflation. I mean, the U.S. government has its own opinions of it, and it wants that because all the debt that it has to pay back will be easier to pay back if inflation allows more money to come into the system. If you owe $100,000 and your wages keep going up because of inflation, that'll be easier and easier to pay off as time goes on. And that's what people don't understand about inflation, which is why it's positive for assets. It comes in and then it pumps up the price of assets, which then triggers the public to go, wow, this stuff has pumped up everything. I got to get into it. Look at this. I'm going to buy this stock. I'm going to buy Bitcoin again. And it starts the next trend. And if you're in at that point, all you have to do is ride the wave. If you aren't in, you're chasing it and it sucks. That's why it's good to be in a downtrend because you finally have time to buy. You've been chasing it and you never get it. Maybe you get a little nibble here and there, but you never get the thing you want. Well, guess what? You have the chance. And everybody else that's complaining is giving up on it because they don't know what they're missing. They were just paying attention to the hype. They're not paying attention to the long term. Look at this drop, right? Coca-Cola hasn't even dropped to its median price yet. All the action we've had in this entire year has brought the market down. But Coca-Cola is still not to its median price. It's quite a bit above it. You're still in the money if you have Coca-Cola over the long term. You're still happy. Nice big red drop, chance to buy. We're probably going to get some kind of consolidation or jump in this level, and if the market keeps going down, then Coca-Cola will go with it. Everything is tied into everything. The indexes have so many different stocks, so the movement of one thing usually reflects the overall market as well. Although, if there is a reason to have it, like Coca-Cola pays a dividend, it causes people that wouldn't normally be in Coca-Cola to move over when the opportunity comes in. Because there are people that are like, all right, I got to jump out of growth stocks. I got to jump out of cyclical stocks, all the things that are getting crushed right now, and jump into something that I know is safe. What's safe? Bonds and dividends. Dividends are basically bonds of the stock market. So people jump into this to get the yield, and they get a nice yield and continued growth with Coca-Cola. Because there are a lot of stocks that don't give you growth. They only give you yield. My perfect example is Verizon, one of my favorite stocks. I own Verizon. It's probably my biggest, actually it's my second biggest holding. But I like the fact that it pays a dividend. But look at Verizon right now. It's disgusting. You know how much this hurts? I was buying Verizon in the 50s and 60s. Like, when it dipped to the low 50s, I'm like, oh, all right, here's a deal, right? And in the 40s, whoa, it's in the 40s. No, dude, look at this. It's in the 30s right now, and then it reports the other day and gets absolutely massacred on that report. Why? Guidance. The most important thing, what do companies think is going to happen? And that's what we need to talk about. So let me make sure I'm getting everything right here. Archegos Capital exploded on Verizon. Yep. I'm just paying attention to the fact that the overall market is in a downtrend. People are looking for stuff to get rid of. They're looking for stuff to buy on dips. But what are the dips going to be? To me, this is a buy, right? Because if you look at Verizon historically, and you think about the industry that it's in, look at it's not moving very much. If you go on the long term, this is back all the way to 1997, right? So down here in 1997, it was around $28. And if you go all the way to today, right, was it like 97, 2007, 2017? So 20 something years later, we're at $35. 35. We went from 28 to 35 in a decade and a half. Good, big deal, right? But that's not the actual picture. If you look at the picture, it's been trading in the median for a long time. Why? Because it has a lot of monetary issues. It burns a lot of cash because maintaining a network like that is expensive. It's not easy to continue to make profits on things because your raw material costs are continuously going up and you don't have much say over those. I mean, you could bid on them, but it's a commodities market. So it's going to be difficult to get the things you need to lay the lines, to make the poles, whatever, the whole deal, to print the circuits and make the infrastructure and the computers and the data centers and the land, whatever it is. It's expensive to be a company like Verizon or the actual tower companies that maintain those lines and towers and things like that. So to me, the fact that the market has caused people to panic and get rid of Verizon, they've looked at it as like, oh, this doesn't gain very much. It has a good yield, which is what I love about it, but it doesn't continuously gain all that much if you're looking at it in the short term. Since 2018, it's been in this tight range. This is why people dumped it, because for the past 4 years, you've gotten zero return. Right? You get these nice pumps up to the 60s, but they're quickly shot back down into the 50s and the high 40s. And that happens over and over again. And in the pandemic, that happened, but because Verizon was an essential company and everybody needed the internet more than ever, they bounced like crazy. But they have their ceiling, so they came right back down afterwards. But to me, this is not a different company from it right here. Like, the company that's right here is no different than the company that was right here. Or the company that was back, well, it's a little different than the companies back here because we're in a whole different world that they couldn't have even pictured back in the late 90s. But it's a nice drop, and it doesn't move that. How much red do you see on this chart? Sometimes you see these drops right here, but this is an insane amount of red. This is too much red. It's dropped so far that I love. I've been buying it since it was in the high, like 38. Yeah, I remember like below 38 or around 38 is when I started buying more shares again, because you don't see this. I've been trying to get it at like 54. I've been trying to get it at 52, stuff like that. And when you're seeing it way cheaper than that after a huge red drop, I know there's going to be a bounce. And the earnings report told me that like this is definitely going to have a bounce sometime in the future, but it's going to hurt for the rest of the year. It's probably going to be another candidate for a tax loss sell in December, pre-Santa Claus rally, if that's what happens. That's my thought. Like, we've got the two Fed meetings, we got earnings season, and then we've got that Santa Claus thing, plus the election. And the relief from the election is going to help. Also, it's going to tell you what's going to get funded, because different candidates are promoting different things. You know, there's like cannabis candidates. There's candidates that want to work in the oil industry. There's candidates that want to promote green infrastructure. There's people that want to promote XYZ, whatever it is. So whoever gets hired is going to whoever gets elected is going to be influencing the industry that actually moves the stock market. So you'll see things change after that, and you'll also see a relief when things don't change. So stuff can stay the way it is, and the shorts get squeezed out, which is what the longs are hoping for. They want things to stay the same. Yeah. So Verizon, it looks good to me. I've been buying a little bit of it. I think it could go lower, but with the dividend like that, here's the other point. Like, when it was up here at $60, you were getting about a 60-something cent dividend. So to me, that is a good deal. I like it. It was like 4-point-something% yield. It's got a little bit of growth, not much, but it's, like, the dividend has been raised consistently for 14. Now it's going to be like 15 or 16 straight years. Because remember, when I started buying into it, it had been about 14 where they'd consecutively raised dividends. And they're doing that still. So you're paying half the price for a stock that's paying you the same or more in yield. I love that. And, it's Verizon. Like, we're the Internet of Things, self-driving, people just staying at home, Zoom meetings, phones, you name it. They've got their fingers in everything. Streaming services. Like, there's so much that's going on with Verizon. 5G. It's all necessary to me in the future. So I like the fact that it's a chance to buy. But there's probably going to be pain, and I'm okay with that. And that's when you're a buyer, you have to be happy. I am happy with this drop. This makes me so ecstatically happy, especially since it's so red. When you see a drop like this in a stable stock, like even through the pandemic, the Verizon didn't go down that much. This is below the level it was in the pandemic. So that tells you, like, is it really worse than it was in March of 2020? No, not at all. It's better, if not, because it's better, all right? It's better because it's been looking at different things since that point in time. I mean, the stuff that was building up into that section exploded afterwards because you needed to work from home. You needed ways of, like, to isolate rides and things like that. There's just so much that became necessary because of the pandemic, which caused them to have to change what they're doing. And part of the reason they're going down is because they have to spend a ton of money updating things to match what's going on in society right now, which is a good thing, because once they finish that, then they're going to have the thing that other people don't want to spend money on, and they'll be able to do the things that people want done with that technology. So to me, it's a good buy. Like, good. Okay, fine. It's dropping. Oh, big deal. I'm losing money. Yeah, big deal. That's what I want. I want to be losing money. I love the pain. I'm a masochist here. That's what we do. We take the pain and we use it to buy so that when we go up, we can brag about how we took the pain and how good we were, But it's going to be hurt. It's going to suck. Right? Most people are gone. Like, most of the fair weather fans are out of the stock market now. That's why you see these crazy drops. And since we're getting to the end of the year, we have all this volatility planned. It's just going to be insane. I'm just looking forward to the fact that I might even get lower prices. This stock might continue to go, and I might be able to buy it in the 20s. Oh, I would love to be able to buy it in the 20s. But who knows? I think with a thing like this, we're going to have a bounce at some point because it is a good stock. It is being oversold. It's entering an area of high volume, which means more volatility, which means more support, or a denser area is what I should say. If you're thinking of it as a physical structure, there are areas that are lighter and there are areas that are denser. And this is running into density, so it can still go through it, but it takes more force to bust through a dense support level, which is what we have with this volume profile right here. We've busted to the lower sections of it, which means we might even be entering a place of lower resistance, which is fine. But if you look, there's still more down here. But we're way below this median price. We're in an extreme red panic. This has been on Friday, I bought some, when it was down by the lows. It sucked, but hey, you know what? That's what you do. Like, if you believe in something, you do that, and you get ready for more pain. And that's why I don't spend all my money buying the stuff. I just get what I can and go from there. So I got to expand this a little bit because this is kind of annoying me. I like to see what the percentage is. I also like to see what the last price is. I've got my mouse cursor obnoxiously huge so you can tell what's going on the screen. That's been kind of what I've done with the stream to make it easier to see, but it makes it harder to move this stuff because the mouse is freaking huge, and I don't know where the actual point of the pointer is anymore. It's covered up by everything. So it's something I get used to with this. All right, so let me take a look at my list here. We've been talking about everything, mostly been earnings. We've got the Fed. So what is my plan? So my plan is I'm going to take a look at a few earnings reports. The ones I was going over in here, like McDonald's, we've got Meta, we've got Apple, we've got Amazon. That's another big one that's important. We've got so many different companies reporting that are going to make a big splash. And these are just a fraction of them. I was actually looking at the whole list and picking all the companies that I'm familiar with and the ones that, if there was an opportunity, I could take a trade in them. And that's what I'm looking for. So after this week, there's going to be even more companies reporting. It's going to be huge. Like, we're in the heart of earnings season. So you have that initial reporting season. You have the banks. Then you have the heart come out. The heart of earnings seasons come up. And then you start to tail off with the finishing or with the final part of earnings season. So right now, being in the heart, that's where the money is made. I'm looking for any overreaction to something I believe in. So either something bullish that I want to buy, or something that's been overly bought, and I'm looking for a nice short on. And if I'm going to short, I'm going to use options. I don't use shares. It's just easier for me to short calls or buy puts. I prefer to short calls if I can because the odds are higher with that. But sometimes you have to buy puts depending upon what your risk factor is. Because sometimes you can buy some super cheap puts, and it's just a better risk to reward ratio than having to sell options. So that's what I end up going for most of the time. All right, we got a couple of things here. If it says, let's see, is it sensitive to ask your average return just out of curiosity? If it's a no, I can't tell, then it's okay. Basically, I have two $5,000 trading accounts. That's kind of how I roll. And like anytime I make more than that, I put it in my long account, which I don't disclose, but I'm telling you, it's not impressive. I'm a small time trader. Like basically, I'm trading with small accounts. To me, anything under $25,000, which is the limit for the pattern day trader rule, PDT, anything under that to me is a small account, which is what I trade with because I've been burned by spending a good amount of money in a position that I believed in after I thought I knew what I was doing. So I've purposefully only let myself trade with that much money so that way if I blow up, I don't hurt myself as bad as I did in the past. Once I'm confident in the fact that I've continued to make money, then I'll up the amount that I'm willing to risk beyond those two $5,000 accounts. But for now, that's what I do. I do two 5K accounts. I have a long account that I put the profits into. I'm looking at two different strategies. I like to have a long account that I pick. I like an index fund that somebody else manages. And then I like to trade with a little bit of the money to offset the risk of either of those. Like my trading offsets the possibility that those that only benefit on an upturn market will actually get something when the market's going down. And I can use that to continue my long position for when the market switches directions and goes back the way it was, which is what it's going to eventually probably do. If you look at the S&P over time, which I can switch over to let's go with the SPX. I do this like every broadcast, I swear, but it's important. You really should pay attention to this. Then this is what the market looks like in the past like 100 years, right? So we're going back to the 1920s because 1930 is right here. So anything before that is 1920s. So the past 100 years, it looks like a flat mark until we have this big explosion. And the big explosion mostly came after the 2008 financial crisis. This was when we originally turned on the water spigot, and this is the environment that we're in. We're in an environment of high liquidity, ridiculously high liquidity, and low interest rates up until this point. So those low interest rates, those 2% or less, because every time we would go up to about 2%, and then we came down. I should say every time. It was just once, really. We stayed low from the bottom part of the financial crisis and kept it going up until about here. This is when we started in 2015, 2014. That's when we started talking about putting on the brakes a little bit and applying some interest rates, raising them up from historic lows. So we did, and then eventually we got to the point where we had the 2018 crash. So we put on the brakes, and then the election was over. Everything was fine again, and then we had the China trade war, and we had everything else that came after that scared the markets. But it was a chance to get in and move everything higher. So when you see this drop coming down right here, you can think, okay, this sucks, I'm down, or you can think, yes, this is an opportunity. All of last year and the year before, I was getting mad because I missed this jump. I hit this drop so well, but like many bears, I got squeezed and I didn't know how to accept that. And I wasn't on board with the trend until it had gone on for quite a while. People were shorting it the whole way through, but I finally flipped around somewhere around here where I realized, all right, we're above the highs. We've done more than I thought. It keeps going up. I think it's time to switch directions. And I was right. It just continued to go. But at the end of the year, we had a drop, and this is where we are today. So I'm looking at everything for the earnings. I'm looking at everything for the Fed. My actual plan is to watch the Fed meeting. And if the Fed says that they're in line with everything they said before, then I'm going to buy calls. I'm going to buy naked calls for the most part, which is something I don't like to do a lot because that involves a pretty high degree of risk. When you're buying naked options, you're basically saying like, all right, I'm risking X amount of money that I put in. Whatever you put in, it could go to zero, and you're risking that entire amount. And it's within the amount of time that you buy. And the longer out in time you go, the more expensive the options are. So it's tempting to buy closer to the time period that you're in. It's tempting to buy those cheap options, hoping for that big move. So that's what a lot of people are going to do. And I was reading about weaponized gamma. They have a term for it. It's like when options are about to expire, there are a couple of different metrics. Delta is the amount the option moves per dollar move in the thing it's following. So if you have Apple options, every dollar Apple moves, the delta will move more. And that's what you see. And gamma is the change in delta every time there is a dollar move. So if your delta is 30 and the stock moves up $1, your option theoretically gains $30. Now that varies depending upon what the actual selling and buying is in the market. But theoretically, that's what you should get. And you'll get somewhere around that when the prices move for the most part, unless there's some kind of a crazy move going on. If there's a panic or a mania, then you could get more than that. But for the most part, that's about what you should get theoretically. So that tells you, all right, you got $30. But if gamma is also $30, then that means the next time there's a dollar move. So if the stock moves $2, you get delta plus gamma. So in that case, I would get that 30 plus that 30. And when your option is about to expire, gamma is extremely high because any little movement in the stock will be important because that's where the option is going to expire. If it expires worthless, all the money is gone. But if it expires in the money, then it becomes viable. So it's a huge deal if you have an option that goes from being out of the money to in the money. And the gamma is high on those because the delta is pretty much gone. People know that that position is over, but there is always the chance that it could move. And there are traders that come in to take those last few bucks. There's the people that get it when it's up high, drain the money out of or drain the premium out of it, and then sell it, or I guess buy it back in that sense, when it drops to a certain level. Because they don't want to get those last few dollars. Like the way the market moves up in quickness, those options move down in quickness. So the last couple of weeks, the value of those options drops so quickly that you can get murdered if you own them. But if you're selling them, you can make a lot of money because you get to keep the premium. And if you close out that position when the premium is lower, then you keep the difference. You make money. However, there are people that know the option sellers will hedge by buying the stock. So that might make you think, oh, wait a minute. If they're buying the stock, doesn't that mean that it could create some support? It can actually make things move? Yes. That's exactly what can happen. If you have a ton of people selling options and suddenly the stock moves, either one, they have to have that stock already, or two, when they sold you that stock, they have to have bought it to protect themselves on a move like this. Because if you sell a call and you own the stock and the price goes above that call, then you make money. You not only do you make money on the shares you bought, but you make money on the premium from the call you sold. So that's like you make it in two different areas, which is nice. That's what's great about options. But if you don't have that option, if you don't have that stock, you have to buy it at whatever the price is. So you have to take the huge loss of the infinite risk, because if you're going down, it can only go to zero. But if you're going up, there's no limit to how high the thing can go. So if you're selling it and you don't own it, it's extremely dangerous. That causes people to buy at really high prices, which then causes bulls to come in and think that the market's moving up and drive the prices up even higher, which is what a short squeeze is. But that's kind of also how the market works in general. It's not only a short squeeze. It's just the way the market moves. People that need to get out. The people that need to get in, follow that up, keep things moving, and that continues the cycle until the market stops. So if you go back and you look at the market all the way back into the 30s, you can see that we've come up quite a bit. And my point is, the fact that we've come down is not the end of the world. We've gone up so much that we need to come down a reasonable amount. And if we're going long term, the reasonable price of the S&P is about 1,700, below the 200-week moving average, or the 200-month moving average in this case. So we're way above the midsection. We're up at like the 2 standard deviation mark on the long term, which is why I like looking at long-term maps, because you can see that things actually bounce. Like look at this. Right? The closing prices of these two candles right here are very close to the 50-day moving average. That's because there is a lot of trading that goes on around that 50-day moving average. Same with the 100. That's where the pandemic bounced off of. It's the 100-month moving average. It held exactly right. And look at that. It's also a half standard deviation above the median. So there are a bunch of reasons why it could have jumped there. But the real reason is because the government came out and said, hey, let's buy, or I should say the Fed came out and said, we're going to buy junk bonds of companies that are failing. So that way everybody can keep surviving. You can become a zombie company. You don't make anything. You don't provide anything, but you have just enough revenue and debt to pay it off and continue existing. So people can have a job doing something that doesn't do anything. So it's good to look at this stuff over a long period of time. And we're still within a good range. My point is, I'm happy. I'm hearing all this bearish nonsense all the time. Like, yes, it's going to go down. Big deal. That's good. You want to buy in. We need to recover after such a big jump. If you want a healthy market, the price has to consolidate. Every time there's a drop, there's a recovery and a continuation of it, because things are what they are. Our personal opinions are very limited. They're in like one area of existence. We're not paying attention to everything and how everything affects everything else. It's too much for our puny little brains to actually comprehend. So when you see the movements like that, that's what it is. It's the movement of the universe. It's the movement of everything doing what it's supposed to do. And it's with everything else in consideration. You can't consider all of it. Let it go. So you just look at what you can, look at the big trends and say, hey, it looks like it's coming back to a reasonable spot. We are bouncing around the 50 50-month moving average. That makes sense. Long-term time frame, good place to reverse. Any of these moving averages are good places to reverse. The standard deviation channels are good places to reverse. But it depends upon what the Fed says. Technical analysis means nothing when there are fundamental reasons why the market is dropping. Like the Fed is the main reason, and earnings are the second reason, because earnings are going to provide projections, and projections are what both the Fed and the big corporations are providing to the market and telling them, hey, is it okay to buy? Do I have to sell? Should I hold? What should I do? That's what we're going to see with those earnings reports and that Fed meeting. So let me see if I'm missing anything. So you're selling the call option. Don't you deliver the shares to the person that exercises it, and you only make the premium? Yes, if you sell a call option, you owe the 100 shares per option you sold. So that's why I like the wheel strategy. If you have the cash to buy a stock that you like, you can sell puts on it until the stock drops enough to where you're eventually exercised and you own the shares. Great. Okay, you own shares that are underwater, but that's not a big deal, because then you can start selling calls. You keep the premium that you sell the calls for, and you continue to sell the call. And either, number one, the stock goes back up and you sell it for a profit, plus you get to keep the premium from the call you sold, or the stock stays where it is or drops and you sell another call and keep more premium. It's win-win if you own the shares. You just keep doing that. And when you're exercised on the call, you get the cash from selling those shares, which you can then use to buy puts. To sell puts. You can continue the wheel strategy. So I like that. But if you don't have the shares and you're just shorting it out of thin air, you think because you think of the move is going to happen, I'd be careful on that. That one, to me, I don't like doing that. I like making sure I can cover whatever happens, because I just don't want to blow up completely if there's a catastrophic failure. I want to have the ability to advance, but I also just want to continue to play the game. It's more about, like, how can I continue to invest without blowing myself up, rather than how do I make myself $1 million in 6 months. Well, you don't. You either take really disgustingly reckless investment ideas and get lucky, extremely risky investments that just happen to work out, and become a millionaire in 6 months, or you fail. Those are your two options if you're going hard in that direction. So I like to make it a side hustle. I like to make sure that I'm growing slowly. I like to make sure that my knowledge continues to grow over time, and that my intermediate level eventually goes to the advanced level. But for now, I'm intermediate, and I'm just relaying everything I think onto other people to make sure that people don't make the same mistakes I did, because I make a bunch of mistakes. That's all I'm trying to do, is just like vent here, talk to people that actually care about this stuff, because all my friends and family were tired of hearing about it before the pandemic, I should say. The pandemic got a few people I know actually into it. But before that, when I was talking about it, nobody cared. Nobody wanted to hear it. When everything was going up, 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 nobody wanted to hear about it. So I took advantage of that and was in before the whole pandemic and GameStop thing, which I'm glad I was able to get that perspective, because, man, those times were difficult. And if you were new to that market, you probably got annihilated on that. So, yeah, that's what we're looking at. We're looking at some earnings. My plan, that's what I keep going into and not actually doing. So my plan is, I'm trying to get into cash as much as possible. I'm trying to put on little shorts, right? I've got a short position on the overall market. I think it might be in SPXU, which is a levered thing that's inverse to the SPY. But I'm basically betting on a little bit more downward movement with that. But I also have long shares and long options, which I'm adding to. So things I think that are going to be good in the future. One, Verizon, I've been adding to that like crazy. Two, Snapchat just got mutilated in earnings, so I want to add a little bit more on my Snapchat leaps, because I don't own shares of Snapchat. I own leaps in it. Although now that it's low enough, I think I might actually buy the shares, because the shares are going to last longer than the options are. And even if it goes to zero, at least that's okay. I'm not buying a ton of shares. I'm going to buy a mixture of shares and options on that one, because of my $5,000 limit on those accounts. I can only have so much into each trade to make sure that I still actually have some capital left over to continue trading if things go wrong. So, yeah, that's what I'm looking at right now. Verizon got hit hard in that earnings. Snapchat got hit hard in that earnings. Let's take a look at it. SNAP. That one's done with that. But look at this chart. Oh, it's down. It's got a competitor, TikTok, that's just taking all the market share. But what people don't realize is TikTok is still new. There's going to be a hiccup, right? At some point, TikTok's probably going to have a hiccup, and there's going to be, let's go. Look, Snapchat, Facebook, and Pinterest, they look good again. Twitter looks good again. but everything else is getting hit because they think that, that those are the old platforms and the new ones are coming up that are going to take market share, which is true to an extent, but it's not as true as the panic would probably let you believe, because Snapchat, for whatever reason, has the ability to move huge. Look at these candles, right? These are monthly candles. So let me switch to weekly candles, which is how I like to look at that. I mean, look at this candle right here. 1 week it moved a massive amount, and that was because of an earnings report. So I like Snapchat for an eventual bounce, a surprise bounce. It has quite a bit. In fact, this bounce right, where's this? Actually, this bounce right here at the end of last year, I ended up profiting off of, because I was able to get into, actually, no, the beginning of this year. Yeah. So early February of 2020 or 2022, I was able to get into a bunch of calls at the low, and after the report, they bumped up. I made a bunch of money on that one. That was probably my last really, really good trade. Grocery Outlet was the one before that. But basically, since then, I've been making decent money on the Fed meetings. I've been trying to buy calls on the QQQ. So actually finally getting into my trades for the Fed meeting, because tech is heavily affected by the Fed. When the Fed says, like, all right, we're going to tighten people's ability to borrow money, usually that means the speculation in the tech sector is going to take a huge hit, because the speculation in there is kind of a good idea if you continue to go with the bull market, because everybody knows that technology is going to be the thing that ushers in the next era. So being invested in it is a way to ride that, and people are going to do that as much as they can. However, things get hit, and that's a chance to get in on that action, which is why I'm looking at Snapchat and Facebook and things like that. Like, I like Facebook, I like Verizon. Another one I like, Amazon, right? Amazon, these are all obvious picks, and I wouldn't have given them to you a few years ago, but because I've been watching how the market's been going, anytime the big players are down, you want to get the best stocks. Like Amazon is a really good stock, even if it has a bad quarter, which I'm kind of hoping, because I own Amazon and I'd like to buy a little bit more. I bought Amazon in this little patch right here. Like, I think I started it when it hit its low of right after the earnings report, right? Because then it split. Yeah, that was right. I bought it before the split. I remember buying it here, and it pumped up. I was all happy, and then it kind of came back down, and I was still happy because it didn't break the resistance level that I bought it at. And then when it pumped and came back down, we're kind of close to that level as well. So if we go down lower, then I get to bring my average down, which is what I want to do. I'm really looking forward to dropping my average on the stocks that I own. Stocks like Meta and Tesla and Amazon. I own those ones. But on a safer note, I own Verizon. I own Medical Properties Trust. I own a few other stocks that pay me dividends. And then I have some speculations in the cannabis sector, which are getting hammered. Those are my absolute worst positions. They're the ones that are dying and they're throwing off my portfolio, because my trades have been really good this year. This has been my best trading year ever. But the whole cannabis thing is what's offsetting it. So my gains are extremely limited. Like, I'm still up, but I'm just not up as much as I would be if I didn't have the stupid cannabis play from the highs that I bought it on. So anyway, point is, Amazon's another company that's reporting. I'm looking at them. They're a huge influencer on the stock market. If Apple and Amazon and Facebook all guide in an upward direction, the market will bounce on that. Regardless of what your opinion is, and if you think the market's going to continue to go down later, whatever. In the short term, if all these companies provide good guidance, it'll go up. And if they provide good guidance on top of good numbers. See, the numbers don't matter that much. It's mostly the guidance, but that doesn't mean the numbers don't matter at all. The numbers do matter. If like Apple comes in around what the expectations are, that's fine. If they come in above expectations and they guide up, that is a huge boost to the stock market. So we can see if we see companies doing that, the market is going to continue to rally for a while, just because that's a good sign. But if it rallies too much, the Fed is going to crush it. So people know that, and they're going to take their gains. So we're looking at lower highs, most likely on a bounce. We're looking at this range to stay in for a while, right, from here to here. And we're looking for downward movement until the end of the year. So basically my thought is we've had bounce, drop, bounce, drop, bounce, drop. What's to say we're not going to bounce, drop, right? Why wouldn't we do it again? We just did it before. Or if we do another bounce and a drop back to this level, that tells me this is support. So we've tested this level twice, and for now it's holding. So this is kind of a double bottom if the market continues to go. So don't keep that in the back of your mind too. We've hit a very strong support level that lasted for a while, and we bounced off of it. Now that doesn't mean we're not going to break right through it again and continue to go down, but that also is basically some caution for you if you're shorting the crap out of everything. Think about that. Like, if you were shorting stuff and you got this nice drop, take some gains, right? Maybe it'll go lower, yes, and you're going to regret it and think, oh, I wish I had it still. But if you're up, take something. If you're able to take something like roll the options, sell a few shares, whatever it is, take some gains if you've got them. And then you can still continue to play, but at least you've moved some money off the table. So if things really go down, you have an opportunity to buy instead of a huge loss on a play. So, like, that's what it is. Like, is it a loss or an opportunity? You have two options. You get to decide which one it is. If it's a loss, then you're going to feel like it. Crap, you're going to feel like it's a loss. You're going to think everything sucks in the rest of your life, too. Well, great. But then you can think of it as an opportunity. If you were smart and you looked into the company and you really think it is a possibility, you just know things are down right now, that's fine. Take advantage of that. Buy. Because when things flip, they're going to pass you by. It happens all the time. You're going to get passed up by these things that you try to catch over and over again, no matter how good you are. You always think, oh, I'll get the next one. I'll get the next one. Well, every single one you don't. This is the first bear market that I've actually played well. The last two that I've been involved in, I didn't. I thought I knew what I was doing the second time, but I just got absolutely annihilated in the lower stages of it. This could keep going for the next year or two. I'd be so happy about that. I'm in such a good position to deal with that. But I don't think it's going to last that long. I think we've got a projection from the Fed that their rates are going to peak somewhere in the early part of next year. And they're not going to come down right away. They're going to sustain for a while because they have to choke this inflation out of the economy. And the way to do that is to keep the money available for borrowing down long enough for certain aspects to die off. Right? Like they're trying to kill the cancerous tissue of the market by restricting the fuel that it needs to survive. And that's basically what they do. They can only affect the demand side. Now, the government can affect the supply side. The government is able to actually use money to buy things and distribute it to people. So that's why the government and the Fed can kind of work together to move both sides of the market and actually make change where they want to make change. That doesn't mean they have the power to move anything they want all the time, right? There's this conspiracy theory that it's the Fed that controls everything. In a way, they kind of do. You know what I mean? They actually, the monetary system flows through them, really. It is sort of the hub. But at the same time, in the influence of how humans move as a species, they only have so much. They can't move it as much as people think they can. They can make things more enticing. They can kind of ease the superorganism that is humanity into a direction, but they can't push it and guide it directly. You know what I'm saying? It has to kind of wander. They have to make the path open for the superorganism to wander. So that's what they're doing. I think they have more power than they do, and I think other people think that as well. But if in the grand scheme of things, they basically have a little bit of a dial. And that's all they can work with. And they're using it well, actually. So far, they've done a better job than a lot of people are giving them credit for. Because it looks like the inflation that's coming in is starting to at least top a bit. It's starting to cap. Because things are getting harder and harder to maintain, inflation is dropping because the people that had money to continue to bid the prices up no longer have the money to bid things up. So they don't have the support they had when the money was flowing. That's why the price people are willing to pay will slowly drop, because the amount people are willing, the amount people actually have is lower than what it was before. That's something that takes time, right? Because not everybody needs to buy goods every day. A lot of times on the commodities market, they're buying in bulk. They're good for a while, and they come back in whenever they need to or whatever. They have a cycle that they buy it on. So it may not be until the next cycle that people need to buy important things that prices actually have a huge correction. They already have been correcting, and we're still in the midst of it, and it's not over, but it is showing progress to me. The fact that the stock market is down a bit, the fact that inflation reports have kind of stayed in the same range for the past few months tells me, regardless of what the media is saying, it's at least kind of slowed down. Because we were having increases. I remember when 5-6% increase in a month was big, and now we're at 8-9% increase in a month. But it's been that steady 8% for the last 3 reports, which to me is a good thing. That at least tells me that the people with money that can afford to still borrow even at these higher prices are at least reconsidering some of the stuff they were doing, which means the big money is pulling some of what they were doing back and allowing the prices to fall naturally, which when everybody else with less money comes in and starts trying to buy things. So that's what we're going to see. We're going to see the slow decline of prices over time, which is positive for the market. Let's see. Yeah, it looks like I missed that. All right, we're caught up. Yeah, we're caught up on that. Cool. Okay, so I've kind of covered that ad nauseum. How are we doing on time? 4:30. All right, so let me get to the numbers. So the thing, I haven't even gotten to the data yet, right? So we had CPI in between the last report and this report. And I know this is old news right now, but this is what I want to talk about. So CPI was 8.2%, and that's headline CPI. That means it includes the core, which is, all the goods and services that it encompasses, plus energy, i.e. oil and some other stuff, and food, which is hugely being affected by the war in Ukraine and OPEC deciding what their supply should be in order to keep making money. Like OPEC is cutting the amount of oil they're putting out. It's like, is it 2 million? Is it 1 million because of everything that's going on? Whatever. It doesn't matter. It's still squeezing the supply a little bit. So prices are going to go up. Like oil companies are going to benefit. My thought is this earnings season, a great play would be a positive play on an oil company that has a good balance sheet. ExxonMobil, Chevron, Shell, Valero, whatever. Like, look at any of those probably could have a pop. I'm actually looking into those. I don't know which one I'm going to play yet because it really depends. And obviously, this is a very obvious play. So many people are looking at that it's not going to be easy to get into one at a good price. But the fact that people are thinking about it makes me think, well, this could happen at least in one level jump. Right? A level jump to me is when, prices firmly sit. Like when this went down, this was a level jump, right? But when you see this to this to this, this is not a level jump. This is a level jump. So you could see that from what we're getting with this economic data. And right now, the CPI is 8.2%. The estimation was 8.1, so it's above the estimates. And that's what they tried to scare everybody with. They're like, ooh, 8.2, it was 8.1. Whatever, it's in line, right? The previous ones were 8.3, 8.5, and 9.1. So we've gone from 9.1 down to 8.5 the next month, down to 8.3 the next month, and down to 8.2 the next month. So we have 4 months of technical declines. Now, it's not much because it went from 9.1 to 8.2, but that is a 1% drop. That's not nothing. That's something. Now, could that be a dip before things get even more intense? It could be. I've been considering that too. Like, I really don't know. My whole thing is, I don't know what the direction is. My gut feeling is that it's going to be slightly lower, somewhere within this, because we have strength at this level, until we get a point where we can reverse, which would be like after the election, after earnings, after tax loss selling, after everything that happened, the Fed meetings for the rest of the year, and when interest rates peak, which will be somewhere in here, right? This is February, 2023, February, March. This is where we're going to get peak earnings here, like between February and April, May, like this section right here will be when they decide, all right, if things continue to be the way they are, we're going to peak interest rates and hold them there for a while. Once that happens, I think the market's going to relax and start to go up a little bit. Now, it's not going to explode up because there's still higher interest rates. It's not like the problem went away, but the specter of could they go lower went away. That's what we're looking at. Is the specter of the Fed could still drop things lower in your face? If it's not, then you have freedom to start buying again, which is what will create the bottom. It's the specter part. They've already capped the money, which is the first thing they had to do. The people's ability to borrow money has been capped. Now they have to get the mental state, the psyche of people into the bear territory so that they can get prices to go down based on people's fears. Once people's fears have capitulated the price to a fair point, then and everything else has peaked and we've gotten past a lot of these problems that are in front of us, then we have a chance to go up, assuming there's nothing else. So if new problems come up, that can always continue the market. So you never know with that. But if you're looking at things the way they are right now, that's when the bottom could happen, assuming things don't change. So that's what you have to look at with a plan. Like, what can you realistically plan for and what can't you plan for? There are the unknown unknowns, which are the things that you cannot prepare for at all. And then there are the things that you can prepare for, and that's what I'm trying to look at. And that's what I think about with this trend right now. I think that it could continue to go down, and that if it does, that's a great opportunity to actually come in here and continue to buy, which is what I've been doing since things got low. So I'm looking at all these stocks next week. I'm looking at the Fed meeting. We've got the headline CPI a little bit lower, but still high. So we're still waiting on data, and the next one is going to be important. So the thing for me that was a little bit more worrisome, though, was core CPI, because core CPI has gone up each time, right? The prior was 6.3, the one before that was 5.9, and the one before that was 5.9. The current one is 6.6. So core means everything besides energy and food, which means like the main part of the economy, the part that we actually should be paying attention to if you exclude the extremely volatile parts, has been continuously climbing. And if it continues to do that, then we have a pretty big problem, because headline is one thing, and headline is up because we have extraordinary circumstances. It's not every day that there's a war in Ukraine, that Russia's invading a country. Like, it's my entire lifetime, right? I think when I was born, it was still, the Cold War was still going on, and when I was a little kid, it was all resolved, right? Well, it should have been, but it wasn't, because like that's why we have what we have now. More stuff happened, but anyway, in that time, things have been relatively stable on that border up until the whole Crimea thing, right? Because there's a whole border dispute and everything. So to me, the fact that we have this thing that is like, people are talking about like, oh, it could be World War III, is extraordinary. You don't have that every day. So we've got that now, and you know what, for as a trader, whatever, we're going to work past that, because most likely that's not going to end in the catastrophe. The absolute worst scenario is the least likely one that happens, and that's what the media pumps. Like, any situation has a range of possibilities. There's not one possibility, there's a range of it, and the media always goes with the most extravagant one to scare people, right? Any big political topic will be something that they use the extremes on to get people involved now, and get people scared, and get people doing whatever it is that they want them to do, to buy stuff or to invest in these things. I'm trying to round things up. We've got headline CPI down a little bit, core CPI up a little bit. The PPI was, it was a little bit below estimates, because the estimates were 7.3. It was 7.2. The prior was 7.3, so that's down a tiny bit. You know, that doesn't mean anything really, but it could. So the possibility that it means something is still in my mind. So I'm not paying too much attention to it, but I'm also thinking like, that is something to take into account. Don't just let it go by the wayside. The last thing I have here is the mortgage rate is 6.92%, which is, well, it might even be higher now. I don't know. But at the time I took these notes, 6.92% was significantly above where mortgage rates were about a year and a half ago. I mean, they were in the threes. So we've basically doubled mortgage rates. Housing prices are dropping. That's one big part of the thing. The problem is the supply is low. So we're having a price boom from the lack of supply, but we're having a price bust from the Fed increasing interest rates, making it more expensive to take out loans to buy houses. So there's kind of two inverse forces acting on each other. And right now, the Fed is actually succeeding in driving prices down a little bit. If we didn't have the lack of supply, prices would be plummeting right now. Because we have that, things are moving a little bit slower, which actually might be healthy in the long run, because then it allows people to get in and out at better prices without such extreme movements that they decide to quit and not come back. You know, like a gradual climb will allow people to think about things and, you know, get back in if they need to at a more reasonable price. So we're having some movement. I think there's going to be more. And as the Fed tightens, there's definitely going to be more, because that's going to put even more stress on mortgage rates. Every time the Fed ups rates, it's not just about the stock market, the bond market, the Forex market, and all those. It's about the real estate market. It's about the economy in general. It's about the price of milk. It's about everything. You know, so the fact that companies can get money easier, or companies have a more difficult time getting money, makes all the difference in the stock market. And that's what I'm looking for. Are we bottoming? Are we continuing? So those are the data points. We got some Fed ideas. So Fed President Mester thinks that the biggest risk is we don't raise rates high enough. They're trying to scare the markets with hawk rhetoric, right? They're trying to be more hawkish because they've succeeded in the money market, making it more difficult to borrow, but now they have to continue to crush the psyche to make sure that prices stay low long enough for people to not jump in and inflate them too quickly. You know, so that's what Mester's thinking. They're like, the risk is we don't raise rates high enough and we don't tackle the problem of inflation before it really hurts everybody. So that, to me, tells me that they're willing to actually really hit this thing. At least Mester is. Like, each individual Fed president has their own vote, and they all have to come together at each meeting and vote on whatever the rate hike is and the policy measures are. So Mester is definitely getting hawkish, and that statement is more to scare the markets into not being so crazy than it is actually what the person fully thinks. But I definitely think that's what they actually believe. So there is that. Bullard was saying the first half GDP might be revised higher, so everybody thinks of it as negative. It might actually end up being flat. Like, GDP isn't just one number. It's revised multiple times because you don't always get all the information in right at the deadline. I mean, things that take a while, like supply chains that have delays and things like that, might have to file late paperwork or something, and then you get a revision to the original number because, like, oh, we actually have more than we thought. It just took us longer to get in the notice for it. So there's all that stuff, and it gets revised, and so far the negative number has been revised higher each time, so it is getting a little better. And if they do revise it to break even, then I don't know if that technically means recession anymore, or well, two consecutive. I guess it would still, because the break even would be lower than the previous reading. So you could argue that, I guess. So anyway, he's thinking that it might be flat. He's expecting Q3 GDP to be positive. He says rate level needs to be right, and to move, and they're going to move it. Then they're going to move into data dependency, and they're data dependent right now, but they're going to get even more data dependent later because they're still kind of running on emotions, kind of running on the psyche aspect of it, and they're trying to scare people into making sure they do what they do. All right, now Kashkari said there's some more evidence that supply chains are improving, which is very important and something that people need to pay attention to. The reason inflation is as bad as it is because the transport has been a problem. Okay, so we're talking about Kashkari. We've got some evidence that supply chains are improving. That's important. He says the labor is still tight. Rates are going to take a year or so to saturate the economy. So what he's been saying is, and I agree with him, every time they make a movement in the rates, in the quantitative tightening policy, it doesn't fully saturate the market for quite a while, usually a year or more, because you need time for those people to not be able to get the deals they were getting before and get increasingly desperate and take different deals. That's what you have to wait for. You have to wait for people to, like, wait each other out. We're basically waiting for waiting right now. People are waiting, and we're waiting on their waiting. So that's what we're trying to do is outlast that. All right, so the next thing I have on here is the Bank of England is saying it's going to buy government bonds again. This is the third time it's stepped into the market, and it's doing that to keep pension funds from collapsing because people are selling, short-term bonds or something like that. Yeah, they're selling gilts, right? That's their version of the government bonds. The pension funds were selling them out of solvency concerns. They thought some wouldn't be able to pay anybody back. So that's why they're getting rid of it. So the government stepped in and said, all right, if you're scared, then we're going to go ahead and protect you. Or I should say the Bank of England. So the central bank stepped in and said they're going to do that. So it's temporarily stabilized things, but the sell-off resumed a little bit afterwards, and it's forcing them to step in again. So we're getting... there's weakness right now. There's definitely a reason for things to drop. It doesn't mean it's the end of the world, but they're all over. It's not just one market. It's not just the U.S. Every market is having an issue of some sort right now. So that's telling you we're going to have some movement. Like, it's not positive. It's more likely down than up. But we could bounce. I'm always going to say that. We could always bounce. Never take that possibility off the table, no matter how bearish you get or how bearish the situation looks. Because the people that thought this red streak was going to continue got hammered in this. This squeeze right here murdered all of them, basically. It murdered most of them because they were smart. They took profits in here, but if they rode it all the way down, this is where they got caught. And even though it went down, they might have doubled up, and boom, they got caught again. Now this is the actual death throes right here, these big jumps. So we're probably seeing a little bit of that again. I don't know if that's going to continue. What else do I have on here? I already got to weaponized gamma. There's some crypto stuff. Basically here. All right, I'm going to do a quick thing of crypto. Let me switch over to the Bitcoin and see what it is doing. BTC. So Bitcoin is quite down, like it always is. No big deal. The crypto market's been like that for a while. I don't expect anything less from it. It's going to be in this range until there's a reason for it to move up. And the reason would be the stock market and the bond market and everything else, the entire economy. It's following the economy. The fact that it hasn't gone below this level, to me, is actually really positive. What I like about this is it's been here for months, and when it bumped up and came back down, it stayed. Every time it gets to this level, it doesn't drop because we have high volume. You can see with the volume profile right here, it's very high, and there's a little low patch right below it, which means if we drop, we can drop quickly into this level where most people are long. This green section right here is the point of control, which is the point where most people have long shares. So going up into this, there was a lot of buying, but this is the area. This is the price. So right around at that, this 9,600 level on Bitcoin, that's where most people are long. So I'm not surprised. I remember buying in the 3,000s and the 4,000s and stuff like that. So there are a lot of people from that era. And when it got to that point, that was where it looked like it was not going to pass, because it was staying in that level for quite a while. That's why I ended up dumping a bunch of it, which sucked, because like I got this, like I had stuff during this and I sold stuff up here, but the majority of my crypto was dumped right into this little dump, or this little pop right here. So unfortunately I missed this whole thing right here, but that's probably fine, because this drop would have been insanely painful, although I would have been buying and would have been even more profitable here. But this drop would have been the worst. So the fact that I sold isn't terrible. I made a good amount of money on it. I'm fine with that. I missed a big run up. That's okay. I'm just planning on the next one. So I am buying little by little in this range. But the fact that it's staying there and it's not dropping any lower for now, like I'm not saying it couldn't, but the fact that it's staying there for a long period of time tells me that this is a pretty good point of support, and it's a place to look out for, and it's a place to accumulate shares, because it's going to be a lower point of control, not the main point of control, but it's going to, because of the volume, it's going to be a place where a lot of people own shares. So when it goes above that, there could be strong support, and if it drops below this, there could be like magnetic pull back up towards it too. They don't talk about support and resistance. They don't talk about like the magnetic pull that certain levels have, because there are people willing to make deals in this area. It entices people to jump the bids and jump the asks and get to these prices that are way above what it looks like right now, because they want in so bad they're willing to pay more than other people to get in, or they want out so bad they're willing to take less than other people, whatever it is. So you can see that, and that magnetic pull will bring the price back to that level. And I think this 1900 level kind of has that. It kind of has the magnetic pull to keep things in line with Bitcoin and Ethereum. Like Ether is the same way. Let me switch over to /ETH real quick. It's at a low point. People are really unhappy with Ether, but I love it, man. Like Ether has even bounced a bit. Bitcoin was kind of still at this range low. Ether is at like the range medium. And look at where the point of control is. Ether is actually at the point of control. I didn't even realize that. This is interesting. So the fact that it's sitting there means that it's got the most support out of anywhere on the chart. And Ether has so many different projects based on it, so people actually believe in Ethereum. And Ethereum it's just a great product to have in the crypto space for another bounce. I know you could probably make more if you found some altcoin that was less than a penny and it went to $100 or whatever. Yeah, but like, which one is going to do that? You really don't know. For every one that does it, there are hundreds that don't. And you're more likely to be in one of those hundreds that don't. So I like Ether as a safe bet. And I own some Ether. I own some Bitcoin. I own a bunch of altcoins too. But I have little investments in them at this point, because I'm still not sure about how much lower it's going to go. And the stock market is going to dictate that, because a lot of people that own cryptocurrency are in the tech space, which means they're in those companies that are in the tech sector, i.e. the NASDAQ, which is the thing I like to trade. So the NASDAQ has a good amount of movement, and it has a big tie to Bitcoin. So if the NASDAQ moves, it can drag Bitcoin with it. Not always, but it's a good thing to look at. So I look at that. Ether is down at the point of control. I like that. I've been adding cryptocurrency. I've been adding the stocks that I like. Verizon, that was another one I talked about. And that's really what I'm doing. I'm adding small amounts. I'm kind of increasing the from small to medium at this point. I'm starting to buy a little bit heavier because things are lower and they are at a much more attractive price. But I'm still being careful because I think it could drop a little bit more. So that's basically all I wanted to talk about today. I mean, that's not true. I could go on forever, and there are so many things that I don't say, and after the programs, I always remember like, oh, I should have said that, I should have said that. But that's all the diarrhea of the mouth I have time for, because my throat is starting to hurt a little bit, and I have to go because I have other things going on. But basically, this market is a great opportunity. We're probably going to have more volatility. We've got this earnings, one of the biggest earnings reports of the year. We've got a very important Fed meeting coming up. We have the election, which is probably more important than either of those, because once that's settled, I think there could be a bounce from there. We have a Santa Claus rally, and we have a tax loss selling season probability. So all of that mixed into one means you got to pay attention to so many different things. That's what I'm doing. I'm trying to make bets here and there, short a little bit on the overall market, buy the positions I like long, wait for opportunities to make little trades, and be safe with your money. That's what I'm doing. So I'm a Stocklips. I do this every other Sunday night, 3 p.m. Pacific. Come and join me. Talk about your stocks, your options, your crypto. I basically just kind of sit here and talk about everything that I think is going on, and what my opinions are. And I hope other people come on and bring ideas in and stocks and options they want to talk about, because those are the best streams when people come in and start talking. So I'm going to get out of here. Thanks for joining me. Thanks. Hey, the Juice Gorilla, I appreciate you too. Appreciate you coming in and hanging out on the stream. Puncher of Kittens, thanks for coming by, joining up. Everybody that was talking today, I really appreciate it. I'm going to get out of here. It's been a really interesting week. I'm going to be, that's the last thing. I'm going to be doing a stream live Wednesday, November 2nd during the Fed meeting. That's when I'm going to that's when I'm going to consider making another trade. I don't know if I'm going to make a day trade, but it depends upon what Jerome Powell says. If Jerome Powell comes out, says everything's in line, and the market looks like it's bouncing, I'm going to jump into something for a short-term trade possibly, if I feel comfortable. If I don't, which lately I've been feeling really weird about it, so I'm actually going to try to convince myself to not make a trade this time. The last 4 Fed meetings, I've made a trade, and it's all been the same thing, basically. It's worked out in the same way. But the last one, it didn't go up as high as it had in the past, and it kind of freaked me out a little bit, because all the other ones had this nice squeeze for like at least a couple of days afterwards. But the last 2 didn't have much of a squeeze, and this one that we had didn't even last the entire day. It fell at the end of the day. The previous ones at least squoze for the day, right? Yeah, I'm using the word squoze for that. This is what I would do. I want to make a t-shirt that says that too. That's kind of my thing. It'd be kind of cool to wear that around. Anyway, all right, I'm going to get out of here. We've got a lot coming up, so I'll be on the live stream here on Twitch Wednesday, November 2nd at 11 o'clock a.m. Pacific time. You can translate that to wherever you are. That once the rates come out, that's what we're going to have. So that's the start of the stream. I'm going to start when the rates come out, and then I'm going to talk about what I'm planning on doing and see what the market does up until Jerome Powell starts to speak. Because when Jerome Powell starts to speak, that's when things start to really move. So that's what I'm waiting for. If things move in my favor, I'll make a trade. I'll post it on stream, talk about it. We'll have a discussion, and then wrap it up on the weekend after that. So, but for now, I got to get going. I'll see you later. Be safe with your money. Thanks for tuning in, and I'll talk to you next time.